Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the complete guide to stock market analysis for smarter investing. The stock market can feel overwhelming, but understanding it doesn't have to be. Stock market analysis is the key to making smarter investment decisions, whether you're a beginner or an experienced trader. By examining trends, performance, and data, you can uncover opportunities and reduce risks. This guide will break down what you need to know, step by step, so you can confidently approach your investments with the tools to succeed. What is stock market analysis? Stock market analysis is the process of examining and interpreting market data to make informed investment decisions. It involves evaluating the performance of stocks, industries, and overall market trends to determine whether to buy, sell, or hold specific assets. Think of it as using a map before starting a journey. It guides you through the complexities of the market and minimizes costly mistakes. By analyzing historical data, financial statements, and market behavior, investors gain the tools to predict future movements and reduce risk. Whether you're an individual investor planning for retirement or a day trader aiming for quick profits, stock market analysis plays a vital role in shaping successful strategies. Two primary methods dominate this practice: fundamental analysis and technical analysis. Let's break them down further. Difference between fundamental and technical analysis. Understanding the difference between fundamental and technical analysis is like knowing whether to rely on a car's engine diagnostics or the speedometer. Both approaches have value, but they serve entirely different purposes. Fundamental analysis. Fundamental analysis focuses on the financial health and intrinsic value of a company. Investors dive into balance sheets, income statements, and cash flow reports to assess whether a stock is undervalued or overvalued. They also consider external factors like industry conditions, economic trends, and even geopolitical events. Key elements of fundamental analysis include earnings reports, a company's profitability over a specific period. Valuation ratios, metrics like the price-to-earnings (P/E) ratio that measure value. Market position, a company's competitive standing in its industry. This type of analysis is ideal for long-term investors seeking steady growth, such as those building retirement portfolios. It requires patience and a deep understanding of the business itself. Technical analysis. Unlike fundamental analysis, technical analysis zeroes in on price charts, patterns, and volume data to predict short-term market movements. It assumes that all relevant information about a stock is already reflected in its market price. Popular tools used in technical analysis include candlestick charts, visual representations of price movements over time. Moving averages, identifying trends by smoothing out price data over days or weeks. Indicators like RSI or MACD, tools that evaluate momentum and potential reversals. This method appeals to traders focused on making quick, frequent trades based on timing rather than a company's long-term prospects. It's all about what the stock is doing, not why. In short, fundamental analysis evaluates the value of an asset over the long term. Technical analysis looks at patterns to predict short-term price movements. Both methods can complement one another. For example, an investor might use fundamental analysis to identify solid companies and technical analysis to time their entry or exit points. The importance of stock market analysis. Have you ever heard the saying, "Don't put all your eggs in one basket"? That's especially true in investing. Stock market analysis helps you avoid risky decisions, ensuring your investments are balanced and grounded in solid research. Here's why it matters: reduces investment risks. The stock market can be unpredictable, but analysis acts as your safety net. By assessing financial data, broader market trends, and potential warning signs, you can identify risks before they become costly mistakes. Would you invest in a sinking ship? Of course not. Analysis ensures you're steering towards stable, profitable options instead. Fundamental analysis protects you from investing in poorly managed companies or overhyped stocks. Technical analysis helps you set stop-loss orders, reducing the impact of sudden market dips. By being informed, you're making calculated moves, not gambling on blind guesses. Assists in portfolio diversification. A well-diversified portfolio is like having different tools for different tasks. You wouldn't use a hammer for every household repair, and similarly, you shouldn't rely entirely on one type of asset or stock. Stock market analysis lets you pinpoint investments that fit with your overall financial goals and risk tolerance. For example, if one sector looks unstable, you may shift funds to a more stable or growing sector, e.g., moving from tech to healthcare. Analysis helps you strike the right balance between growth stocks and dividend-paying stocks, depending on your time horizon. By diversifying wisely, you're spreading your bets across high-growth opportunities and safer, long-term options. Builds confidence and control. The more you know, the less uncertainty you face. Stock market analysis empowers you to take control of your financial future. Instead of reacting to market noise or headlines, you act based on solid evidence and logical plans. It eliminates guesswork and builds a strong foundation for your investment journey. In a nutshell, stock market analysis is your compass in the chaotic world of finance. It keeps you focused, helps you manage risk, and ensures your portfolio grows in line with your goals. Why leave your financial future to chance when you can build it with insight? Fundamental analysis. When it comes to stock market analysis, fundamental analysis is like getting to know a company from the inside out. Instead of focusing on stock price movements, it digs deeper, analyzing the financial health, management, and market position of a business. The goal? To figure out if a stock is undervalued or overvalued. If you want to invest confidently and for the long term, mastering fundamental analysis is essential. Key metrics used in fundamental analysis. To evaluate a company effectively, fundamental analysts rely on certain metrics that paint a picture of its financial performance and efficiency. These numbers aren't as intimidating as they look, they're like puzzle pieces that, when put together, show the bigger picture. Here's a breakdown of the most commonly used metrics. Price to earnings, P/E ratio. Think of this as a stock's price tag relative to its earnings. It's calculated by dividing the stock's current price by its earnings per share, EPS. A higher P/E ratio could mean the stock is overvalued, while a lower one might suggest it's undervalued. However, always compare this within the same industry to get clarity. Earnings per share, EPS. EPS reveals how much profit a company makes for each outstanding share of its stock. It's a simple way to measure profitability. Higher EPS usually means better performance. Return on equity, ROE. ROE measures how efficiently a company uses shareholders' money to generate profit. It's expressed as a percentage, and a consistently high ROE is typically a good sign of solid management. Debt to equity, D/E ratio. This metric tells you how much debt a company is using compared to the equity it has. A high D/E ratio signals that a company relies heavily on borrowing, which could be risky during economic downturns. These metrics won't give you all the answers, but they serve as a foundation for making informed decisions. A quick tip? Always analyze them together. There's no one-size-fits-all number. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.